Hi, I'm Jenny Kiffmeyer, and I am an ERISA attorney at the Retirement Learning Center. Welcome to our regular segment on Case of the Week. This week's case relates to the topic of qualified charitable distributions from IRAs. Keep in mind, these are real-life cases drawn from calls to our consultants on the resource desk from financial professionals all over the country. So our question today is, what is the latest information on making qualified charitable distributions from IRAs? Well, in general, a qualified charitable distribution is a tax-free donation up to $100,000 indexed that an eligible IRA owner or beneficiary directly transfers from an IRA to a qualifying charitable organization. In addition to that annual $100,000 contribution, there is a one-time election to make a qualified charitable distribution to a charitable split interest entity. The deadline to complete any qualified charitable distribution is December 31st, 2024 for 2024 tax purposes. So got to get that in by the end of the year. And note that making a qualified charitable distribution does not entitle the individual to an additional itemized tax deduction for a charitable contribution. Now, Secure Act 2.0 made two key changes to qualified charitable distributions. Number one, it added that new ability, that one-time gift option to the split interest entity, and that is defined as a charitable remainder unitrust, a charitable remainder annuity trust, or a charitable gift annuity. And that $50,000 limit is actually indexed. So for 2024, it is $53,000, and for 2025, that limit is $54,000. The second thing that Secure Act 2.0 did was also index the annual qualified charitable distribution limit so that the 2024 amount is $105,000 and the 2025 amount is $108,000. Now let's focus on who is considered an eligible IRA owner or beneficiary for this purpose. It has to be someone who has attained age 70 and a half or older. That is the IRA owner or the beneficiary. They have to be 70 and a half or older, and they have to have an IRA, a Roth IRA, or what's considered an inactive SEP or SIMPLE IRA. Now, to be inactive means that there are no ongoing employer contributions to the SEP or the SIMPLE IRA. Next, defining a qualifying charitable organizations, we have to look to the Internal Revenue Code under Section 170B1, capital letter A. And this is going to include organizations like churches, educational organizations, hospital and medical facilities, and foundations. To help you, the IRS has a handy online tool. It's called Exempt Organization Select Check. If you go to the irs.gov website, and you'll come up with this handy tool that can help you identify organizations that could qualify for tax-deductible charitable contributions. Now, why would someone want to make a qualified charitable distribution? Well, those amounts are excludable from taxable income. If you are in RMD status, so if you're age 73 and over, you can count that amount towards the RMD for the year. The qualified charitable distribution is going to lower taxable income for the year. It's a great way to be able to give to a favorite charity. And if it's one of those split entity beneficiaries, it could be a way to give some money to a charity and then have a gift available for a beneficiary as well. Some other miscellaneous rules, there's some important 1040 reporting steps and also withholding rules that apply. Please take note of those and talk about those with your tax preparer. And finally, in closing, just wanted to remind everyone that, as year end approaches, eligible IRA owners and beneficiaries age 70 and a half and over, including those with inactive SEP or SIMPLE IRAs, can make qualifying charitable distributions. Again, for 2024, that distribution or transfer to the charity has to occur by December 31st of 2024. In closing, as a financial advisor who works with IRA owners, you can play a pivotal role in helping them with cases such as this. And if you are looking for a more in-depth written version of the case, you can find it, of course, on our website, retirementlc.com. Thank you.